Hello. In this video, we'll continue with our corporate formation discussion, and we'll look at corporate formation problem number 2. Cantaloupe, Honeydew, and Watermelon, all individuals, plan to organize Mellon Corporation to engage in the melon seed design and manufacturing business. Now, the melon seed design and manufacturing business is a pretty big business, actually, if you look it up. Cantaloupe, Honeydew, and Watermelon each receive 20 shares of Mellon Corporation common stock. So they each receive 1/3 of the corporation. Cantaloupe also receives a promissory note for $200,000 due in 10 years with interest at a prime rate payable semi-annually. So the idea here is that Cantaloupe is going to get a future payment of cash from Mellon Corporation, and in the meantime, he's going to be paid interest, and then all the principal is due in 10 years. And the prime rate is a very similar to market rate, payable semi-annually. It's plain vanilla, just like some type of corporate bond. Now, the following items are received in exchange for contributing to Mellon the following items. So, again, Cantaloupe, Honeydew, and Watermelon each receive 20 shares of stock, and Cantaloupe, in addition to that, receives a note for $200,000, and again, it has promised to pay that in 10 years, and it has semi-annual interest payments at the prime rate. So all of these items that Cantaloupe, Honeydew, and Watermelon transfer to the corporation, the amounts are provided below at the date of contribution, and all exchanges occur simultaneously at the same time. So Cantaloupe is going to contribute to the corporation construction supplies, which Cantaloupe held as inventory for 4 years, and the adjusted basis that Cantaloupe had in those items at the date of contribution is $300,000, and the fair market value of those construction supplies is $450,000. Honeydew and Watermelon each contribute $250,000. Now note that Cantaloupe contributes $450,000, Honeydew contributes $250,000, and Watermelon contributes $250,000. Now notice that the fair market values of all of these items added together, for Cantaloupe $450, Honeydew $250, and Watermelon $250, the value of those assets, this is what the corporation is getting on formation, is $950,000. However, we also have a liability here. The corporation is going to have a liability on the books of $200,000, and that is the amount that it owes Cantaloupe. And the reason it's taking on this loan is because they're all three receiving 1/3 of the shares, 20, 20, 20, so 60 total shares, right? 20 over 60 each. There's 60 total shares, each person receives 20, so 1/3. But again, this is arm's length, just like we saw in our previous examples, where each should be contributing $250,000. Well, unfortunately, Cantaloupe is paying more. It's giving construction supplies worth that more, so the corporation is having to give Cantaloupe some additional asset, additional payment of $200,000. So that's what's going on here, okay? And to summarize that, let's look at Cantaloupe. It's always good to start a problem by simply see what exactly is being transferred. So Cantaloupe is transferring construction supplies, again worth $450,000, to the corporation, and the corporation is transferring two things to Cantaloupe. The first is the 20 shares of stock, and the second is a $200,000 note. $200,000 note. Now, if you note, these equal. The construction supplies equal $450. The shares of stock equal 1/3, because that's what Cantaloupe receives, of $750, right? Because when you net the assets and liabilities, the net amount is $750,000. When you net those numbers and you multiply that by 1/3, Cantaloupe is receiving 1/3 of that, which is 20 shares. Cantaloupe receives $250,000 worth of shares. The note is worth $200,000, so 450 equals 450, so we're in balance because it's an arm's length transaction. There's nothing here that suggests it's not. And Honeydew and Watermelon each contribute $250, and that's simply just the value of the stock, and that equals. So we have that. So remember that whenever a corporation is formed and or parties contribute property, here we have formation, right? They plan to organize, which means that they form Mellon Corporation. Whenever we have a corporate formation or contribution, we have to apply some special rules. And we saw this in problem 1. If you have not yet watched problem 1, I highly recommend stopping this video now and watching problem 1, corporate formation problem 1, and coming back. And we have these corporate formation and contribution tax rules that we have to apply. And there's 6 steps, and we should follow them in order. Because if we follow them out of order, it makes this process a lot more inefficient. So the first step is we look at the gain or loss recognized by the transferor shareholders. So the transferor shareholders here are Honeydew, Watermelon, and Cantaloupe. So we first start by looking at the gain or loss recognized by the transferor shareholders. The second thing we do is we determine the adjusted basis of the stock received and other property by the transferor shareholders. The third item is we determine the holding period of the stock received. And items 1 through 3 all deal with the transferor shareholders. Steps 1 through 3 all apply to transferor shareholders. Steps 4, 5, and 6 deal with the transferee corporation, which here is Mellon Corporation. So step 4, we determine the gain or loss recognized by the corporation, by the transferee corporation, which here is Mellon Corporation. Item 5, we determine the adjusted basis of property received by the corporation. So here that would be the construction supplies, the cash. And number 6, we determine the holding period of that property received by the corporation. Of the property by the corporation. And remember that holding period matters because if you have something that's capital and it's sold, especially if you're looking at individuals, then it can be long-term capital gain. And also it matters for corporations because when you're looking at issues as well, like capital gain, you have to take that into account as well. So that's our 6 steps. Now we're going to go through those 6 steps in order, and we're going to start with steps 1, 2, and 3 for each of the shareholders, and then we'll go to 4, 5, and 6. Okay, so let's go ahead and start with step 1, and we're going to focus on Cantaloupe first. So we're looking at our transferor shareholder Cantaloupe, and we're going to go through all the shareholders, steps 1, 2, and 3. But first, let's start with Cantaloupe. So step number 1, we're determining the recognized gain or loss. And remember that the recognized gain or loss is the actual gain or loss that goes on the tax return. But before we calculate the recognized gain or loss, we have to always start with our gateway provision, section 1001, which we determine our realized gain or loss. This is always the gateway for property transactions. Here, this is a property transaction because we have a property exchange. We have an exchange of construction supplies, which broadly defined in section 1001 for property, that's property, for stock, and for a note. So we have a realized gain or loss calculation. Remember the realized gain or loss calculation, we take amount realized minus our adjusted basis of the property given up, and that gives us the realized gain if it's positive, or realized loss if it's negative. And then from there we determine, well, if that's 0, then the recognized gain or loss is going to be 0 as well. So amount realized, remember, the amount realized is, again, in layman's terms is what exactly are you getting. Adjusted basis is what you're giving up, the basis of the property given up. A tax technical definition of amount realized, 4 things we add together: cash plus the fair market value of non-cash property plus any liability relief minus selling expenses. So let's go ahead and apply this to cantaloupe. So what is cantaloupe getting? Cantaloupe is getting 20 shares of Mellon Corporation common stock and a promissory note for $200,000. So cantaloupe does not have any actual cash, no liability relief. This seems like it might be a liability relief, but actually it's property that's being received. So the value of those shares, remember, we have to determine the value of the corporation, which we did earlier. The value of the corporation is $750,000. Cantaloupe receives 20 over 60 shares, so that's $250,000. That's what Cantaloupe gets. So each shareholder gets 20 shares, which is worth $250,000. So the value of the stock that Cantaloupe receives is $250,000 plus the promissory note, which based on these having a prime rate, it's semi-annual, being plain vanilla, the value of that note is very likely to be $200,000 because it's paying adequate interest, market rate interest, and a $200,000 payment at the end. So the amount realized is $450,000. What is the adjusted basis of property given up? That would be the construction supplies, which is a basis of $300,000. So we subtract away $300,000. So the realized gain is $150,000. So now we need to determine, okay, we have a $150,000 realized gain. What portion of that, if any, or if all of it, or if none of it, is going to be recognized? So now that we've determined the realized gain is $150,000, we need to apply our Section 351 analysis. And we start with Section 351A, which in our checklist, Step 1 is Part 1, because that is the non-recognition rule that applies, the general non-recognition rule that applies when there is corporate formation or contribution to a corporation of property. Okay? Very important. So if you have not yet watched problem number 1, I highly recommend stopping, watching problem number 1, because that introduces this topic, and then problem 2 just continues with it. So if you remember, for Section 351A, non-recognition to occur, there's 3 requirements that have to be met, and we'll go through all 3. The first is that there's a transfer of property to a corporation by one or more persons. So here, the question becomes, is Cantaloupe transferring property? Well, Cantaloupe is transferring construction supplies. Remember that property is very broadly defined through the law. It's not defined in the Internal Revenue Code, but through the case law and whatnot, property is very broad for Section 351 purposes. So, do we have property, construction supplies? Yes. To a corporation? Yes. To Mellon Corporation. By persons? Well, Cantaloupe is doing this as part of a plan to organize all together with Honeydew and Watermelon. So yes, there is property to a corporation by persons. And this requirement usually is not the most missed one. It's usually the ones you're going to see next. The second requirement is it in exchange, solely in exchange, solely is key, solely in exchange for stock in such corporation, in the corporation that received the property. So let's see what Cantaloupe received here. Cantaloupe received 20 shares of common stock, which that is stock, right? That is plain vanilla stock. Again, this is not preferred stock. You don't have to worry about the special rules preferred. This is common stock. So this is stock. But what else does Cantaloupe receive? Cantaloupe receives a promissory note, which is a note that promises to pay money in the future and also interest over time. And that is not stock. This is actually debt. So Cantaloupe is receiving more than stock. So Cantaloupe fails requirement number 2. Now, if you remember from our previous video, if you fail requirement 2 but meet requirement 1 and 3, you still might get partial non-recognition. So we can't get section 351A non-recognition, but let's continue with item 3 to see if we can get partial non-recognition, because if we meet item number 1 and number 3, but fail number 2, then we apply section 351B. So we go to number 3, and number 3 is immediately after. Immediately after. That's the key. Immediately after the exchange, the person or persons, so here persons, because cantaloupe, honeydew, and watermelon have control of the corporation. And I always apply the before and after test. So before, how much ownership did cantaloupe, honeydew, and watermelon have collectively together? 0. After, what did they have? Well, they all did this together. So this is all part of the same integrated transaction, the same under the Intermountain Lumber. It's all done together. It's all planned together. So, and it's all simultaneously. So you don't have to worry about, one happening one day and one happening a few months, which the IRS might come in and scrutinize that. It all happens simultaneous. After, they all own 100%. They own 60 shares all together. So the question becomes, if you remember, what exactly is control? So control is two things. Two things have to be met. 80% of all classes of stock and, 80% or more. So greater than or equal to 80% or more of all classes of stock and greater than or equal to 80% of voting. So is that here? Well, there's only one class of stock here, so yes. It's all, and it's greater than 80% or more of voting because it's 100%. So we do meet requirement number 3. So since we meet requirement 1 and 3 but fail requirement 2, we apply another provision. So again, if we failed requirements 1 and 2, then we would be done. We would not get any recognition. The realized gain of 150 would have to be recognized. But if we fail only requirement 2 but meet requirements 1 and 3, we apply a partial, what I call partial non-recognition rule, which is under section 351B, which deals if boot is received. So boot is anything other than the stock in the corporation. And actually, liability relief can be considered boot, and we'll talk more about that in a later problem. So the rule is, for section 351B, we look at whether it's boot or liability relief. Here it's boot because it's property other than stock, and it's not liability relief. So we have boot. The rule is it's the lesser of the fair market value. So the gain recognized, the lesser of the fair market value of the boot, or it's limited to the realized gain. But if there's a realized loss, you can never take a loss. You can never take a loss under this rule. So remember, section 351A is mandatory, no gain or loss shall be recognized. Well, 351B, only for gain. It's only a gain rule. It's never a loss. You can never have a loss. So if there is a realized loss and 351B applies, it's still going to be 0. Very important to understand. So we look at the fair market value of the boot, which is $200,000. And the realized gain, which we calculated before, is $150,000. So which is lesser, $200,000 or $150,000? So that means that we have to recognize the realized gain of $150,000. That's the portion that becomes recognized. We compare the $200K, which is the fair market value of the boot, to the realized gain, which we calculated before, which is $150,000. We take the lesser of those two, which is $150,000. Now note that this rule, what it does is that, remember that one of the issues with the reason we have non-recognition rules is liquidity. If you are simply transferring property in exchange for stock, where do you get the cash to pay the taxes? Well, here you're getting boot. And the idea is that, okay, well, that, a lot of times that boot might be cash or something. Well, there has to be some limitation on this because you can make this too good to be true. Another aspect of the non-recognition rule is economics. And if you're getting stock and something else, from the corporation, then you're not truly, just moving money from one pocket to the other like we saw in the introduction to Section 351 issue. So Cantaloupe's recognized gain is $150,000 in step 1. Okay, so we just calculated the recognized gain for Cantaloupe, $150,000. The realized gain is recognized because it's a lesser of the amount of boot or the realized gain. So now we need to determine the adjusted basis. This is step 2 for Cantaloupe. The adjusted basis of all property received. So the adjusted basis of property received by Cantaloupe. So here, that is the 20 shares of stock and the note. So the stock and the note. So I want to go ahead and let's go ahead and determine the basis of the note. So any boot, which again, boot is anything that is not considered stock in the corporation that Section 351 applies. The boot, the basis, the adjusted basis of any boot received will be its fair market value at the date of receipt. So the adjusted basis of boot is fair market value. It's like a cost basis principle. So here, that is the note. The note's basis will have an adjusted basis of $200,000. $200,000. So that's pretty easy. So we also have to calculate the basis of the stock, the 20 shares of common stock. And since Section 351 applies, right? It was Section 351B, but still Section 351 applies. We apply the basis rule, because remember, every non-recognition rule has a basis rule, and that's under Section 358. And if you remember again from our previous videos, we start with the adjusted basis of property transferred, which here Cantaloupe transfers construction supplies, which have an adjusted basis of $300,000. And we adjust that item. We carry that over, and then we adjust that for a few things. The first thing is that we subtract away any actual cash received. We subtract away any actual cash received. Did Cantaloupe receive any actual cash from the corporation? No, so that's 0. Then we subtract away any constructive cash, which again is liability relief. Is there any liability relief here? No. There is no liability relief, so we subtract away 0. We then subtract away the fair market value of any non-cash property boot received, which here we have a note which has a fair market value of $200,000. So we subtract away $200,000. And then we add to that any gain recognized in step 1. And again, this is why we follow the steps in order, because again, it's going to make your life a lot easier, especially when you have to do this with closed book. So we recognize $150,000 gain, so we get to add that. So that portion gets added. The idea is that you shouldn't be taxed on the portion you've already been taxed on. So that's the idea, and that's with non-recognition. It simply defers. So $300,000 minus $200,000 is $100,000, plus $150,000 is $250,000. So the adjusted basis of the 20 shares of stock that Cantaloupe receives is $250,000. Okay, so we've gone through steps 1 and 2 for Cantaloupe. Step 3 is to determine the holding period of the stock received. The holding period of any boot that's received, which here is the note, is going to automatically, or going to be a fresh start, just so you know. It's going to be a fresh start as if you purchased it new. But the holding period of the stock received can potentially tack. Remember, tack you get to add on. So that's important to understand. So I'm going to go ahead and write that down. The holding period of boot, which here is the note, is always a fresh start, which means that it starts running, the clock starts running on the date that it's actually received as a result of this transaction. That's for the boot. But the holding period of stock received, remember, because stock is a capital asset, makes a big difference. Well, that that aspect, it depends again on the property received. So remember that if it's a capital asset, I'm sorry, not the property received, the property that's given up. If it's capital asset or Section 1231 asset, then that portion tax. But if it's not one of these, or it's cash, then it's a fresh start. It's a fresh start and starts new. So here, Cantaloupe is giving up inventory, right? Construction supplies held as inventory. You always have to look how exactly is it held by the taxpayer. It's inventory. Well, inventory is not a capital asset and it's not a Section 1231 asset. So therefore, it's in this category and it will be a fresh start. So that means that all 20 shares, I'm sorry, all, or I should say 100% of each share, 100% of each share, because we don't look at it by number of shares, we look at each share. Of each share equals fresh start. So if the stock was sold the next day by Cantaloupe to another investor, then it would be short-term capital gain or short-term capital loss if the value went down. You have to hold it for a year and a day to get that long-term treatment. So it's fresh start because, again, it's not a capital asset being contributed or a Section 1231 asset. Very important. So we've gone through steps 1, 2, and 3 for Cantaloupe. So now let's talk about Honeydew and Watermelon. We're going to do those two together because you're going to see that these two taxpayers, steps 1, 2, and 3, are going to be extremely easy. And what you're going to notice is that whenever a taxpayer in a corporate formation or contribution just contributes cash in exchange for stock, it's like the easiest thing in tax. So we have Honeydew and Watermelon, and we're going to go through all 3 steps. Again, step 1 is to calculate the recognized gain or loss. Step 2 is to determine the adjusted basis of the stock received. And step 3 is simply to determine the holding period of the stock received. So with respect to step 1, if we were to determine the realized gain or loss, it would be 0. And the reason is because you look at the property given up, look at the property received, which is, again, based on our calculations we did for Cantaloupe, they're receiving 20 shares of the 60, 1/3 of the $750,000 value, the shares, right? That's the value, which is $250,000, minus the cash given up by both of them, which is $250,000. That's going to be a 0 realized gain. So that means the recognized gain is going to be 0 as well. So that means the recognized gain is 0 as well. So whenever there's cash for shares, easy. Even if it's cash for shares of other property, it's still going to be, it's whenever cash is paid. That's the idea, is that it's going to be a 0 recognized gain. Okay, the adjusted basis. The adjusted basis here, so Section 351 does apply, by the way. It does apply because you have all 3 criteria. You have the transfer of property, cash is property, solely in exchange for stock, 20 shares of stock, and immediately after exchange, we have control because all 3, Cantaloupe, Honeydew, and Watermelon together. So Section 351A does apply, even though it wasn't really needed to both Honeydew and Watermelon. So that means we have to apply Section 358. Well, for Section 358, for the adjusted basis of the stock, and that's the only property that they each receive, it's simply just taking the basis of the cash, which is $250,000, and then you don't add anything because there's no gain and they didn't receive anything else. So the adjusted basis equals the amount of the cash. So that's for each Honeydew and Watermelon. And then number 3, the holding period. The holding period, because it's cash, remember, cash does not have a holding period, so it's automatically a fresh start, so it starts new. So if Honeydew or Watermelon sold any of their shares the next day, it'd be short-term capital gain because the clock starts ticking as of the date of this transaction. So again, the summary here is that when there's cash involved, it's real easy. There's no gain recognized. The basis is going to be the amount of cash paid in the stock. Okay, I mean, if you are receiving boot as well, you have to break it down by that. And then the holding period is always going to be a fresh start because cash is being contributed. Okay, so we've gone through steps 1, 2, and 3 for all the transfer shareholders, cantaloupe, honeydew, and watermelon. So finally, all that's left is step 4, 5, and 6, which we look at Mellon Corporation. So we're looking at Mellon Corporation for steps 4, 5, and 6. And this is going to be pretty simple. We're going to go through this, and it's going to be quick, and you're going to see it's pretty simple. So step 4 is dealing with the gain or loss recognized. So the gain or loss recognized by Mellon Corporation. And we learned that with respect to the corporation, it's a very broad rule under Code Section 1032, almost always no gain or loss recognized, and that's the case here. So no gain or loss will be recognized under Code Section 1032. So Mellon Corporation has no gain or loss recognized. Okay, step 5 is determine the adjusted basis of all property received by the corporation. All property received by the corporation. And remember that if Section 1032 applies, which it will, then we have to apply Code Section 362 as the corresponding basis rule for the non-recognition rule. So we go through all the different assets. So let's first start with cash. Well, cash is easy. It's always just the face value. So that means that we record cash. There's $500,000 in cash because 250 plus 250 is 500. So that takes care of those assets. The only other asset to worry about is the construction supplies. So the construction supplies, remember that the general rule under Code Section 362 is we start by carrying over the basis by the transferee shareholder, which here the construction supplies had a basis of $300,000 in the hands of Cantaloupe. So that's what we start with, and we add to that any gain recognized in step 1 by that respective shareholder on that actual item. So in step 1, so the question becomes, did Cantaloupe recognize any gain? Yes, Cantaloupe recognized $150,000 in gain. Now, if you have multiple pieces of property, it would have to be the property that created the gain. So here, there's only one piece of property, so it's only this. But if you have other pieces of property, like if you had cash and construction supplies, you would only be adding it to the construction supplies, obviously, because that's what created the gain. It's that property, okay? Because that property has the inherent gain, $150,000 in it, that basically created the realized gain situation. So that means the construction supplies take a basis of $450,000. Now, one thing to note is this is the general rule under Section 362, and you should always apply that generally. But remember that if the adjusted basis is greater than the fair market value of any respective asset, then you have to look at that test. If there's only one asset, it's automatically you use fair market value. But if there's more than one asset, you look at the aggregate approach. So that's step 5. Again, the cash has a basis of 500. Construction supplies have a basis of 450. Finally, step 6, the last step, is the holding period of the assets received, of these assets. And the answer to that is that they all tack. They all tack. Now again, cash has no holding period, so it starts as a fresh start, practically speaking. It tacks theoretically, but guess what? There's no holding period, so well, you don't worry about holding period of cash anyways because you don't have gain. So actually, you don't worry about holding period of cash. That's the idea there, okay? Construction supplies, so there's no holding period on the cash. The construction supplies, though, the 4 years for the inventory, that does. So let's say construction supplies come in and they actually become a Section 1231 asset. Well, to the corporation, well, since it's held for 4 years, as you know, Section 1231 requires that the property be held for at least a year to be considered a Section 1231 gain or loss if sold. So if these construction supplies to the corporation are viewed as a Section 1231 type asset and they're sold the next day, it will be 1231 gain to the corporation because that 4 years gets to tack on. All right, so I hope you've enjoyed this video. I hope you've learned, through all the steps, all the 6 steps in the order that they need to be done. This, is really important for understanding corporate formation. Please make sure to watch the previous videos as well as the future videos because each video really focuses on, more items that you need to understand.